Okay, great. So thank you for joining us. We are here today with Keali Jo from the Advanced Markets team at Ameritas. She's new to Ameritas, right? So we
Mhm.
welcome you. We welcome you to the team meeting, and she has some very interesting facts. Mine in the 1040. I'll record the session. We do have a couple of accountants on the team that would like to join. They will be joining, and if they can't, we'll record and get this message out to them. But without further ado, Kelly, why don't you just introduce yourself, a little about your background, and you can just go right into your presentation. And if anyone has a question online, you can put it in the chat, and that we'll address the questions as they come in through the chat. And at the end, if we have time, you can unmute yourself and you can ask. All right. So with that, I'll let you take it away.
Alrighty, well, thank you so much. Hi, everybody. My name is Keali Jo. I'm going to be hanging out with you today. A little bit about myself. I am a JD consultant for the Ameritas Advanced Planning team. I am semi-new. I joined last June and I love it so far. A little bit about myself. I'm a recent graduate of the University of Nebraska Law with a concentration in estate planning and business transactions. I also was admitted to the bar in September and possess a master's in accounting and an undergraduate in accounting and finance. So it's fair to say I am a lifetime learner. I really love the topic of law and tax. So this seems like a great presentation, and I'm really excited to be here with you today. Now, before we get started, I know accounting can be a very daunting topic, can be very intimidating. Granted, I know there are some tax professionals here with us today, so this doesn't apply to you, or maybe it does. But accounting can be a very rough topic. And so I like to visualize accounting as kind of a gamify, right? I like to make it a game. It's black and white. There's a right answer, there's a wrong answer. It's like a puzzle. Now, tax is a little bit in the gray area, though, for accounting. It's not as black and white, and there is no right or wrong answer. While the government might tell you there is a right answer, it is still an art. It's not really a science. But I still like to think of it as a game. But the name of this game is a scavenger hunt. So we're given our map, which is our 1040, right? And it tells us, okay, we want to find this treasure, our treasure being our information. And it gives us various hints and clues through the forms, through forms and schedules, essentially. So if we follow the forms and schedules through the 1040, we should be able to find our treasure. So if you ever are lost in the 1040, just make sure you're reading the instructions, follow that thread, and unveil where our treasure is. Now, when I said clues, I spoke about schedules and forms. So what is a schedule? Well, a schedule is an additional document that we attach to the 1040 that provides additional information, calculations, or details that may be needed to support specific parts of the main tax return. Now, these schedules come in various shapes and sizes. In fact, I have a list of them on the screen for you now. While all are important and can provide very great topics for discussion, we won't be able to talk about them all today, just purely for time. So instead, today, we're going to talk about the four highlighted here. We're going to talk about Schedule 1, which is additions and adjustments to income. Schedule A, which is itemized deductions. Schedule C, which deals with profits and losses for sole proprietorships and unincorporated entities, and Schedule E, which deals with supplemental income. That's going to be where our like pass-through stuff is going to be located. So with that in mind, without a further ado, let me introduce you to the star of our show, the 1040. Now, Form 1040 is the cornerstone of our federal income tax filing. Everything starts and ends with this document here. If the client sets it in front of you, it's usually because, hey, they don't know what they're looking for and they don't know what you're looking for either. But everything starts and ends with this document, and it should be fairly easy for you to go ahead and look through. Now, when it is given to us by a client, generally it's given to us to find these three things: gross income, adjusted gross income, and taxable income. Now, gross income is essentially income from whatever source derived. That could be like your wages, your capital gains, your dividends, your interest, et cetera. Even your tax exempt income, that goes into gross income. Adjusted gross income, we attorneys and accountants are not very clever. We tend to call things what they are. So adjusted gross income is literally what it sounds like. We make some adjustments to our gross income, those adjustments being some deductions and removing that tax exempt income from that number. Finally, if we remove for taxable income, we take our adjusted gross income and we remove our standardized or our itemized deduction. After that, we can multiply it by our tax rate, and that gives us our taxes due. And usually this is what the Form 1040 is used for. But if you look just a little bit closer, it can provide some really great topics for you to have a discussion on to identify insurance planning opportunities. Specifically, we can have conversations about income replacement, retirement savings, estate and legacy planning, intergenerational wealth, and business planning needs. All of these are really great and powerful conversations you can have with your clients about insurance. Now, I also want to, before we go into the nitty-gritty details, I want to point out how important it is not to just look at this year's 1040, but also last year's 1040 and maybe the year before that. Because while it's great to stay within the four corners of the document, there are some things that can only be told by change, the difference between the two forms. All right, so keep that in mind. It's also important to keep in mind that what information is present is also just as important as the information that isn't present. So make sure we're keeping on the lookout, even if there may not be something entered in any of the fields that we discussed today. Kind of probe a little bit further and think about why that may be the case. And there could be a great insurance sale just waiting for you there. Now let's get into the details of the 1040. The first thing that comes up on the 1040 is our filing status. Now, filing status, a lot of people just go, okay, I get it, I'm done. I don't really care about filing status. That doesn't really tell me much information. When in reality, the filing status can tell you so much information about your client and provide so many different life insurance planning opportunities. So, how can you file? You can file as single, as in you're unmarried and just filing for yourself. Married filing jointly, which means you're married and filing a return on behalf of both yourself and your spouse. Married filing separately, which means you're married and you're filing only for yourself. Your spouse will file their own return. Head of household, which means you're unmarried, but you have some qualifying dependents, people that rely on you. And then finally, you can do a qualifying surviving spouse, which means you were recently widowed. And while you weren't technically married by 1231 of the previous tax year, we're going to give it to you anyway. Kind of a we won't kick you while you're down thing. But filing status is one of the major drivers of planning changes. If someone's filing status has changed, you should definitely carefully review their planning needs and ask yourself, what changed? Consider, did your client recently get married? Marriage is a life event that generally creates a financial interdependence between two people. Newlyweds frequently discover that they need life insurance to replace a spouse's salary or to cover a debt that they might share, like a mortgage, student loans, or a car loan. Now, maybe they just got married, but what if it's not a first marriage? What if it's a second marriage? Well, then we have the issue of potentially a blended family. Now, what is a blended family? That essentially means that you have spouse A and spouse B, and they have children from prior marriages that they come together, get married, and now we have a new family unit. Now, why is it important to? Oh, sorry, I'm going to back up here just a little bit. So, if they recently got married, we talked about those loans and stuff. You can have life insurance to replace those loans or replace the income of their other spouse. If it's a second marriage and we're dealing with those blended families here, well, then we have to worry about transferring wealth. And we can use life insurance as what we call the great estate equalizer. So what do I mean by that? Let's say we have husband has two kids from a previous marriage and wife has two kids from a previous marriage. Husband and wife get married. Wife is the primary breadwinner and she wants to make sure that her husband is taken care of in the event that she were to pass, like any other spouse would. So let's say wife passes and she leaves everything to her husband. Well, what about her children? Two things could happen. We could hope that husband eventually at some point in the future will die and leave some money for her children, or husband might not leave anything for her children. She's kind of at the whim of her husband and things change over time. So what do we do to make sure that those kids are taken care of and that their inheritance isn't delayed for a substantial amount of time? We introduce some life insurance. We have wife take out a policy on herself and name her children as the beneficiary. That way, when she passes, her entire estate can go to the husband. Husband's taken care of. Everything's all the norm, and the kids get their inheritance. So they don't have to guess, well, did mom leave me nothing, or is new dad here not going to leave me anything? Right? So insurance is a great equalizer of the estates. Also consider maybe your client recently got divorced. Fun fact, some divorce agreements require life insurance to meet alimony obligations. I'm not a family lawyer, so I didn't even know that until I was researching this presentation. But yeah, life insurance is used for alimony. And a great way, if they got divorced, you might want to ask them, hey, what is your alimony? Do you have alimony? Is life insurance involved? If it is, let's get you a policy going. Or maybe they're already paying alimony and have been paying for a while. How can you tell? Well, you can check out Schedule 1 on the back page on line 19A. It'll say, hey, alimony is being paid here. And you can ask them, hey, is part of that alimony a life insurance policy? And if it is, when's the last time you reviewed it? Maybe we need to give that policy another check through just to make sure that it's serving the purpose that you need it to serve. Alternatively, what if your client is filing as head of household? Well, these individuals have dependents that rely on them. So the question becomes, okay, what do you want to happen to those dependents when you're no longer around? How do you want them to be taken care of? You, as head of household, are going to be the primary breadwinner and the person that is supporting these dependents. So we're going to need to replace your salary if anything were to ever occur. So life insurance is a really great sale in that point, too. But backing up, filing status can only tell us so much. It's a story, and it's just the first page. So it's up to you to turn that page and dig a little bit deeper to figure out really what's going on here. For example, let's say your client files as single, but maybe they're in a committed non-marital relationship or recently widowed. You don't know, right? You got to talk to them a little bit further. Another example, I'm one of those people in a committed non-marital relationship. I have a partner of 8 years who I adore, who's been with me all through law school. And I can tell you that before I became an estate lawyer, I had no idea what would happen if either of us were to pass. We were still dependent on each other's incomes. We have a mortgage together. What would happen? And once I became an estate planning attorney, I realized, oh, I have to get a will. I have to make sure that I leave things to my partner and he leaves things to me so that we're both taken care of. But an average individual my age isn't thinking, oh, I'm going to go get a will, right? Wills are not for me right now. That's not for me. I can't afford an attorney right now. So, what is another option? Well, life insurance. You can get a life insurance policy on yourself and name your partner the beneficiary. That way, if anything were to happen to you, your income is covered. And I would argue, even if you had a will, it's still really important to have life insurance on that partner because you're not just giving them your things, you're replacing your income and your support for them over time. So definitely always make sure to dig a little bit deeper into that filing status. It can totally give you so much more information than you may have ever thought it could. Now, the next section on the 1040 deals with dependents, and this section also is a wealth of information. So the 1040 asks the filer to identify their dependents. And one thing that we think about is when we have an addition of a dependent from one year to the next, that can drastically change how someone actually thinks about their financial preparedness and their planning. So frequently, professionals will fall into a trap thinking that there has been no change in dependence at all if the no child has been born in a given year. But being born is not the only way to add a dependent. Granted, birth and adoption are the most common scenarios that we have when it comes to adding a dependent. They're not the only scenarios. Consider if you had a disabled loved one or an elderly parent that you had to take care of, they could be listed here too. So when reviewing this section, ask your client, hey, you have loved ones here that depend on you. Do you have enough life insurance to protect them if something were to happen to you? Maybe give it up a follow-up question. I see you have dependents here. How old are they? Because the younger they are, the more life insurance you may need to cover them because they're going to be reliant on you longer. You could also ask of these dependents, which one of them, do any of them have special needs? Do they rely on you in that way? Because that can change how much life insurance you're actually taking out for them to support their care and their costs. You want to provide for them in case something were to ever happen to you. Now, this is also a really great place to ask if you see somebody with special needs, right? A special needs dependent on here. It's a really great place to stop and ask, hey, have you, tax filer, have you considered getting long term care for yourself? And why is this a really great place to bring that up? Well, these taxpayers that have special needs dependents are at the front row of the emotional strain of caring for a disabled loved one. Add to that the cost of care that it may take, it can be really a massive burden and it can be very hard for them to work through. And so they know firsthand how hard and how hard things can be and how valuable long-term care insurance could actually come in handy. Like it can be something that they would actually be more amenable to talking to about. So that's a really great place to ask. And finally, if you have some minor dependents, maybe start bringing up college. Hey, are you planning on providing for college? If yes, are you on track for this goal? Have you considered other investments like life insurance? Access to that cash value could really help out in the future. Next, the 1040 starts asking us about income. So we have the family composition down. That was a wealth of information, a really great place to start, but we want to delve a little bit deeper into the taxpayer's income. So the 1040 begins to identify gross income and the sources from which that income is derived. Now, the most common source of income would be earned income. And that includes things like your wages, your tips, your salaries, and that's reported on line one. Now, if you're a taxpayer, you'll find that on your W-2 or your 1099, but you report it on line one of your 1040. Now, this line one here is the number that needs to be replaced, though, in the event of an unexpected death of your client. So, when looking at how much coverage that you are trying to get to cover this person to make sure that their income is replaced, make sure we're checking out that line one. And I know it may be safe to say this for other, you might just think of this automatically, but I feel I need to say it for somebody who might not think of it automatically. Going back to filing status, you can have single as a non-married or as a non-marital committed couple. You could have married filing separately, which means the people of the couple are filing two separate tax returns. Make sure you have both of them in front of you to get a good idea of how much income this household is actually surviving off of and how much would need to be replaced in the event something were to happen to one of them. Now, another really important consideration is that families today, usually both spouses will provide income that will need to be replaced. But there are some family structures that are a little bit different. For example, some spouses may work offsetting schedules. One spouse may have reduced hours or have one spouse staying home completely. That way they can take care of the children or meet any other family needs. Well, this spouse that has less of an income, or maybe they're a stay at home parent or stay at home spouse in general, they are usually overlooked. They are underinsured or uninsured. And I can't urge you enough to make sure that you do not make the same mistake and overlook them. Why? Because the value of a stay at home spouse is tangible. You can figure out, according to salary.com, $185,000 a year is what a stay at home spouse is worth. And Investopedia takes it further and says they're worth about $205,000 a year in salary. And that makes sense if you think about the childcare, the upkeep of the home, the emotional support to the surviving partner, groceries, transportation, etc. That can add up really quick. So ignoring the stay-at-home parent is a horrible idea because let's say the stay-at-home parent were to pass. Well, yes, the income generating parent, they aren't losing any income per se, but their expenses just shot up through the roof because now they have to replace the services that were being provided by the stay-at-home spouse. So make sure that not only that insurance is in place for both spouses, but that it's adequate and sufficient. Now, there's other types of income. The next type of income is going to be a little bit more passive, and that's income from investment. This income generally comes in the form of interest or dividends, and you can find this information entered in lines 2 to 3 on the 1040. Now, as a taxpayer, you would associate this information with that of the 1099 INT, which is a document you receive from your investment broker annually to report as your income on your taxes. Now, like I said, interest and dividends, while those are the two categories of income investments, they can come in further categories like tax and tax exempt. So starting with line 2A, which deals with tax exempt interest. So clients who have invested substantially in a tax advantage investment, like a treasury bond, is going to have something on this line here. But they're also really good candidates to have a discussion on the benefits of having a permanent life insurance policy as an alternative or as an additional tax advantage investment vehicle. Why? Because it does have tax advantages. You get tax deferred growth of the cash value, tax defer or tax free withdrawals up to the basis, and you have access to that cash value tax free via loans. Of course, you're going to have to pay back the loan with interest, but it's technically not an income tax. And you get a tax free death benefit. So, investing in life insurance is a very tax advantage asset. And so, somebody who has something on these lines that have tax exempt interest may be very interested in learning more about how to diversify or how to substitute some of those investments. So consider asking your clients, how long have they had this investment? What are they earning on it? How are you reinvesting those earnings? And what do you plan on doing with that money? Because they could earn this amount potentially by reinvesting this interest in a life insurance policy and potentially achieve the exact same goal. So that's always a conversation worth having. Instead of tax exempt interest, you could also have taxable interest. Now, taxable interest is usually a higher return than tax exempt interest, but it's usually on a low risk, low reward investment. So these assets, if there's something on this line, it generally indicates like a certificate of deposit, a savings account, or a bond income. These are very low risk investments, but they also have a low reward, usually a little bit more than the tax exempt, but not by much. So an alternative to this low risk, low reward strategy would be to use these assets instead to purchase life insurance. Why? Because life insurance could provide a higher internal rate of return while also providing that tax-free growth potential and the needed death benefit protection. So ask your clients, hey, where is this invested and how much is this earning? And what is this money for? Can they achieve a better investment return with a life insurance policy for substantially similar amounts of funds being invested in it? Potentially, you don't know. Are they concerned about taxes? They're obviously being taxed here. If they're concerned about taxes, maybe kind of point out that life insurance has that tax-free death benefit when they die for the beneficiaries, or that they could take out that loan tax-free from the policy with interest and principal repaid by the death benefit. So there are some really cool conversations you can have here. Finally, with investments, they can come in the form of ordinary or qualified dividends. Now, the name of this game is the source. The source is what we want to know about. Now, dividend income usually is being reinvested, could be a dividend income that is being reinvested could serve as a source of income for potential insurance needs. So we can divert some of that dividend income towards paying the premiums on a life insurance policy. But even if we don't want to do that, we can still have we can uncover some really good insurance planning potential opportunities by just inquiring a little bit further. So ask about the source of where these dividends are coming from. That could lead to more opportunities. So for example, let's say these dividends are coming from a closely held family business. Well, if there's a family business involved, now we're talking succession planning, buy-sell agreements, which are notoriously funded by life insurance, or key person coverage or replacement. So we're always aiming to recruit, retain, and reward our key person, which can involve an executive bonus, a split dollar life insurance, or non-qualified deferred compensation, all of which are funded by life insurance, or key man coverage. So those are some great opportunities that all you had to do is ask, hey, where's this dividend from? And now we're opening up a plethora of options. Alternatively, let's say the dividend income comes from a concentrated stock position, right? So usually these family businesses, they put all their money in this business, right? They don't really have much of an estate outside of that. They just constantly reinvest in this business, and that's what they own. That's their estate. Well, we still need to diversify. We need to move some eggs into some different baskets. We need to protect our family as well. So how, in case of a downturn in the market. So how do we do that? Life insurance, you guessed it, is a great option. So ask first, where is this income coming from? Second, how much are you earning? And third, what is the plan for these dividends? Are you reinvesting them? Or are you interested in checking out other opportunities? Now, another type of income we deal with is retirement income. This area specifically is so important, not just to pay attention to what is here, but what isn't here. So let's say there's nothing here at all. Does that mean we don't have a conversation? No, we do. Because if you think about it, this line 4 to 5, discusses pensions, IRAs, annuities, and Social Security. That means we're dealing with retirement. And many retired clients face a trifecta of risks. Longevity, am I going to outlive my savings for my retirement? And that is more and more of an issue given our mortality rates getting higher and higher. We're getting older and older. Long-term care costs. How you're more likely to become disabled than you are to die. And the likelihood of becoming disabled only grows exponentially the older you get. So it's a constant concern for them. And sequencing of returns, aka where is my next payment coming from if I don't work anymore? Where's that money coming from? Now, you might ask your client, if the market drops tomorrow, how are you sitting with your retirement fund? They may not be sitting so pretty, so they may want to diversify into some whole life insurance. They could have some cash value, and that way, if the market were to drop, they wouldn't have to divest themselves from the market. They could just take some of that cash value out by a loan, and they won't have to realize loss or move their position. So that's a great way to do that. But the best thing is if they have nothing at all, purchasing life insurance can alleviate all three of these risks. If you purchase a life insurance policy, it can help provide a source of supplemental retirement income, our sequence of returns, to backstop outliving our retirement assets, our longevity, but it can also provide long-term care protection because you can get a care for life rider on your death benefit. That way, if anything were to happen to you, maybe you don't need that death benefit, but now you can use it to fund your long-term care. And even after that, let's say all of that was great. Well, the policy values that aren't depleted during your lifetime, you can still then pass on to the next generation income tax free through that death benefit. So let's say there is something here, though, right? That's for somebody who isn't, there's nothing in there. But let's say there is something in there. Life insurance still alleviates those three risks. So we still want to talk about them. But we might want to also talk about leveraging what their distributions are. So let's say they're taking distributions, they have some number in here. You're going to ask them, hey, what are you using this for? Do you need this to support your living? Or are you just taking it because you're required to take it? Because, RMDs, you're required to take them every year. And often you don't want to take them every year. So what are you doing with this money? Because if they don't need it for their living style, if they don't need it to maintain their level of living, standard of living, you meant what I knew. If they don't need it to maintain the standard of living, well, then we can leverage it into a policy. And how we would do that is we'd take the required minimum distribution or whatever fraction of it that they don't need and put it in a life insurance policy via premium payments. We'll build up some death benefit. That way, it's a gamble. Of course, if you pass away sooner, you get a bigger death benefit for a smaller outlay of funds. If you pass away later, you still get a death benefit, you just put in more funds. But the best side of this is you'll still have access to cash value. Now, it's not going to be 100% of what you put in for premiums, but you're going to have a significant portion of what you paid in premiums available to you via cash value. That way, it's just always there that you can take it. And again, once we have a life insurance policy put into place, we can add that care for life rider that'll take care of you in the event that you require long-term care. So really good opportunity to talk here. The next type of income the 1040 asks us about is capital gains income. Now, capital gain income is sourced from the sale of appreciated property. So essentially, it's equal to the sales price minus whatever your basis is. And this type of income, known as capital gain income, is reported on line 6, and it tends to be taxed at more favorable rates, 0, 15, or 20%, depending on the AGI, the adjusted gross income of the taxpayer. Now, what some people don't think about, though, is the higher income earners with passive income may be subjected to an additional 3.8% surcharge tax. This is known as NIT, net investment income tax. Therefore, if your client has a lot of investments that are earmarked for legacy purposes, specifically like they don't plan on using the income to support their lifestyle either now or in the future, they may be better served by leveraging these assets into a more tax efficient legacy asset, such as life insurance. So ask, where is this money invested? Do you have any other capital gain property that you haven't sold? Can future or current unsold investments be invested in a more tax efficient manner? And finally, rounding out the income conversation on the 1040, we have kind of this catch-all line, which says additional income from Schedule 1, and it gestures for us to open up Schedule 1 and report any additional income or adjustments to income that we may have. Now, we briefly mentioned Schedule 1 at the beginning of the presentation regarding alimony. Again, alimony received there is at the top for 2A. That's the additional income, the money you're getting in. On the second page of the document, it has money that's going out, and that'll have line 19A for alimony paid. But this document has a little bit more than alimony. It has a ton of things on it, like gambling losses. It has, let's see, unemployment compensation, everything you may need. There's a lot of stuff on here. So we don't want to just throw it out. We want to take a little view at it. One line in particular I would draw your attention to is line 3, business income or loss. Now, I want to caveat this. So while this is business income or loss, it's not every business income or loss. It only deals with sole proprietorships or unincorporated entities that are not pass-throughs, aka not partnerships, not S corporations. So while it doesn't have as much information, it still has a lot of information because we're dealing with a business. And every business has the same type of conversations that need to be had revolving around insurance planning. Specifically, succession planning. Are we funding that buy-sell agreement? Is there one in place? Covering your personal needs, which may include creditor protection. In many states, it'll vary by state. Creditor protection is extended to life insurance policies. So if anything were to happen, like in your business, the creditor couldn't come and take that policy. Again, that varies by state. It could deal with retirement planning or used to help cover long-term costs, long-term care costs. Or it can be used to deal with key employees, whether that's recruiting, retaining, and rewarding them, which is so important because our key employees are the lifeblood of our business, but also protecting against the loss of that key employee. So why would we recruit, retain, and reward our employees? Well, they're usually the value driver of everything we do. So we could do that. We could reward them with executive bonus, split dollar, or that non-qualified deferred compensation, all of which are going to be funded by a life insurance plan. And this way, our employers can retain their employees and make sure that their business continues to run smoothly and not worry about competitors coming in and stealing them away. Alternatively, we still want to protect against the loss of the key employee in the event that our recruit, retain, and reward isn't enough. So we do that by getting out key man insurance in order to protect ourselves in the event, because we don't think about all the costs that relate to a key employee's loss. I mean, we do think about the fact that we'll have to train someone new, we'll have to pay someone new and recruit someone new, but we don't think about all the costs. For example, this one person leaving may trigger an avalanche of other employees leaving. It might decrease morale. It might actually have a substantial impact on your revenue stream. These are like indirect things that could happen, but we want to make sure that we're ensured that if they do happen, we have the money and the funds to actually meet those burdens. Now, if you ever run into a business owner or have these business conversations, I highly, I can't stress enough, recommend the Ameritas Business Planning Fact Finder. Now, this business planning fact finder is designed to give you open-ended questions to have an actual conversation with your client while gathering all the information you may need, or we may need if you end up bringing the case to us, to provide a very comprehensive look on what their plan is and what their plan is missing. So again, that's the Ameritas Business Planning Fact Finder, and that can be found on Producer Workbench, and I'll be happy to send out a copy at the end of this presentation. Now, notice how it says, see the attached Schedule C. Well, if we dig down a little bit deeper, we follow our treasure map, we'll find more treasure, and that's in Schedule C. So for the accountants on this call, you'll be happy to know, if you didn't already, that Schedule C reads just like an income statement. It's pretty nice. It gives you profits, expenses, and cost of goods sold before arriving at your net taxable income. Now, the area that we're most interested in here is going to be the expense section. So we're not interested in all the expenses because there's a ton of stuff in here like advertising, depreciation, taxes, and travel. We don't really care about those. What I do really care about is the employee benefit programs, pension and profit sharing plans, rent, utilities, and wages. Why do I care about them? Well, first, the employee benefit programs, pension, and profit sharing plans. We want to make sure that the employers are taking advantage of the tax deduction that comes with the expenses related to employee benefit programs. And we can actually facilitate some of those deductions with helping pay for like life insurance. If we give a Section 162 bonus, well, that's compensation that's being provided to the employee. Well, then we can take a deduction for that. Now, not to mention the importance of these kind of programs to the employee recruitment, retention, and reward, we need to make sure that they're actually doing the things that they need to do in order to keep their employees. And if they aren't, if there's nothing in here, we go, hey, have you considered trying out these new programs? Have you considered some DER, which is our endorsement split dollar? Things like that. Alternatively, this expense section provides information on rent, utilities, and wages paid. Now, what do all these things have in common? Rent, utility, and wages paid. They are persistent in a business, which means if something were to happen to you, these expenses would still be due. You'd still have to pay the rent on the building you use. You'd still have to pay the utilities to heat it, and you still have to pay the salaries that you have out there. So even if you become disabled or heaven forbid have to close your business temporarily, these costs are still coming due. So what can you do to protect yourself if something were to happen? Now, you may be thinking disability income insurance, and you're partially right because disability income is a pretty good way to go. You're replacing your income if you're disabled, but that doesn't cover the costs related to your business. That just covers your income. And if you think about it, when you run a business, you have all your profit, you take out all your expenses, and then you pay yourself an income as the owner. So why, after all of that, would I pay myself an income and then reduce my income by the expenses that are still persisting? That seems silly. So what can I do? Well, I can check out what's called business overhead expense insurance, or BOE. Now, BOE is a type of disability insurance that supplements disability income insurance. So disability income insurance, while also important to have, only covers that lost income due to a disability. It doesn't cover expenses beyond that. Business owner, however, must replace more than their income in order to have the business survive. So they replace those persistent costs like rent, utilities, and wages by the funds received from this insurance. So it's a really good thing to check out. Highly recommend reaching out to somebody in DI if you're interested in learning more about that. Now, going back to our Schedule 1, it also gives us a line on rental real estate, royalties, partnerships, S corporations, and trusts, and that can be found on line 5. Now, this is that alternative to the business. These are going to be our pass-throughs, but it also, like it says, rental real estate. So we're going to take these in turn. Keep in mind this all returns on one line, so we don't know how to split between rental real estate, partnerships, and S corporations without digging a little bit further into that Schedule E. But let's say we're talking about rental real estate. Well, there are some conversations that we can have right off the bat if you know that this is rental real estate. And again, check out Schedule E. We'll go into that here shortly. It'll tell you if it's rental real estate. But let's say it is. Well, there are 3 things that we can talk about when it comes to real estate. And this is for pretty much anybody who owns property, even if it's not in a business. The first thing we can talk about is mortgages. Many um, Many income producing properties have mortgages on them, and that is a big debt on the balance sheet for them. So what do if something were to happen to you? Well, these mortgages are a persistent cost. They will continue if something happened to you and if you lost your income, and they continue if you die too. So if you were to pass away, either they sell the building and recoup their costs, or they take assets out of your estate to pay off the mortgage so you can take the asset debt free. Now, there is a thing called mortgage insurance that beneficiaries can purchase that essentially is like a reducing term insurance where we put an insurance on the building in an amount equal to the loan that is outstanding. And then if something were to happen to you, say you die, the insurance proceeds will then go and pay off that loan so your beneficiary or your business can take the asset debt free. Another issue on the top of their minds would be property management. So many clients manage their own rental properties themselves, or maybe they're going to hire a management property company. Regardless, one of those things need to happen because the property needs to be managed. But what happens if you don't have an income anymore and you can't pay to have somebody do it, or you're disabled and you can't do it yourself? What do? Life insurance. Life insurance or disability income insurance can be used to replace the cost, or at least the income used to pay the cost of hiring that property management. Finally, we deal with estate equalization. Now, rental real estate, or just real estate in general, is a non-liquid asset. And what do I mean by that? I mean, essentially, you can't just sell it right away. You can't split it up very easily and just give it away, right? It takes time. It's hard to split up. And it may be hard to divide amongst beneficiaries. So, for example, let's say I have dad. Mom passed away a while ago. Dad runs a farm and he has three kids. And one of his kids is so invested in this farm, they want to continue the family business. It's important they keep it in the family. That's their whole life. The other two kids could really care less about the business. They don't really want to be farmers, they want to do their own thing. Well, most, like I said earlier, most small businesses tend to put all of their money into the families, put all of the money into the business because that's their main asset. And so Farmer Dad here, he did the same thing. Most of his asset is this farm. So when it comes time to figure out his will, or when it comes to when he passes, what happens to that farm? Well, there's a couple options. He can A, give the farm, or he can sell the farm and give the proceeds split equally between the three kids. We don't want to do that because he wants to keep the farm in the family business and the kid wants to keep it too. He could give all three kids a share in the business, but two kids don't care about it. One kid does, and they could be outvoted, and that's probably not a good idea to run a business. Or option number three, we can go ahead and take out some life insurance. Why would we do that? Well, we can give the farm in its entirety to the kid who wants it. We can take out a life insurance policy to equate that same value of the farm for the other two kids. That way, dad, farmer dad, who loves all of his kids equally, can leave an inheritance of equal value to each and make everybody happy. And we do that through life insurance. So, those are three things you can definitely talk to anybody who has real estate on. But let's dig a little bit further. So if we go down in that Schedule E, it'll give us more information about the rental real estate and the royalties. And that information can be found in Part 1 here. So Part 1 has you specifically list out all the rental real estate and the royalties. And it lists things like the physical address and the type of each property. And this is handy when it comes to ascertaining the estate planning needs of the client. So you may not know this, but there are 12 states plus the District of Columbia that have either an estate tax or an inheritance tax in addition to the federal estate tax. And so it's important to be able to plan for those situations because we want to make sure, one, we have enough assets in the estate to pay whatever taxes due. And two, maybe we want to replace that, whatever it costs to pay off those taxes, with a life insurance policy. So why is it important to check this out? Well, we're looking at the physical address of each property. We do care where the taxpayer is, like where the taxpayer dies, because the state that they die in is going to govern the disposition of their property and the taxes that are applied to them. There's an exception to that, and that's with real property, aka real estate. Real estate is governed by the law in which the dirt it sits. We call it the situs. So whatever state that property is in, that state law is the one that's going to govern. So by looking here, we can see, oh, maybe our client doesn't live in a state that has estate or inheritance tax problems, but look, they own property there. We might want to start planning for that so we can make sure that there's enough money set aside to pay the tax via like using a life insurance policy, for example. So that's a really great one, or we can also use it as a wealth replacement vehicle. Now, going further down on our list here, it details the income and the expenses from our rental and real estate. This is all still in Part 1. One of the lines on here actually is for insurance. So maybe consider asking, hey, what kind of insurance do you have out there? Maybe they don't have mortgage insurance, and maybe they'll be interested in learning a little bit more about it. So it's always worth an ask. If it says insurance, I always ask, hey, what kind of insurance do you have? How much coverage is it? And when's the last time you reviewed a policy? Now, going back to our Schedule 1 on line 5, again, this has more to do with than just real estate and royalties. It also covers partnerships, S corporations, and trusts. Now, this conversation is going to be similar to the conversation that we had with line 3 when it came to business income and loss for sole proprietorships. Again, every business owner needs to talk about these key things. Succession planning, how are we funding a buy-sell agreement with life insurance? Creditor protection, again, states will vary, has to be individually owned. Retirement planning, long-term care considerations, non-qualified arrangements to help retain and reward valued employees, and key person insurance to help protect the business in the event of the loss of the key employee. Now, we just talked through all of these things a little bit earlier, so I'm not going to belabor the point, but just keep in mind, anytime you have a business owner, whip out that business fact finder and you should be good to go for your conversations. But it's still important to learn a little bit more about that S corporation. So if we go back to Schedule E and we go down to Part 2 this time, Part 2 of Schedule E lays out all the income or loss from the partnership or S corporations. So if you receive a K1 from your partnership, this is where you would enter that information. But what does this tell us? Well, if there's information here, then it tells us that the client not only has a business, but that business is a pass-through entity. Now, why is that important? I'm going to speak about this in the context of S corporations, but just know that it does apply to both partnerships and S corporations. So, S corporations, they do offer tax advantages like pass-through taxation, avoiding the double tax that we see in C corps. Pass-through taxation, what does that mean? It means essentially instead of us taxing the entity by itself, like you would for like a C corp, we let the money flow through to you, and you'll report it as if you earned that income yourself on your own tax return. So it's a passing through the business and on to you. So that's pass through taxation. So S corporations do pass through taxation. And another thing that's important is that the owners who are also employees can reduce their payroll taxes by balancing their salary, aka the stuff that's subject to payroll taxes, with distributions, which are things that are not subject to payroll taxes. So the owner has these options. Okay, it's an S corp, it's flow through. I can either take a salary and get paid with payroll taxes, or I can take a distribution. But because it's mine, because it's passed through, a distribution would only reduce my basis. It wouldn't really subject me to income, like payroll tax income. It's still income if you exceed your basis. But yeah. Now, there are challenges for an S corporation too. For example, fringe benefits. Fringe benefits for employees are generally not taxable to them. However, fringe benefits that are provided to shareholder employees that own 2% or more are going to be taxable to them. So they're not going to want to give themselves fringe benefits if they can avoid it. Moreover, W-2 wages are the sole basis for funding qualified retirement plans, which incentivizes the owners to minimize their wages more and maximize these distributions, which could actually limit how much they can save for retirement. So, introducing our S Corp security strategy, at least that's what we call it at Ameritas. The S Corp security strategy, it's one of our complete solutions. Under this strategy, we propose using the S Corporation's distributions, not wages, distributions, to fund a permanent life insurance policy, which will offer that tax-deferred growth and potential retirement income. Now, life insurance policies also provide diversification, creditor protections, again, varying by state, and flexibility compared to ERISA qualified plans. These benefits can include a stable death benefit, potential living benefits for long-term care, and tax advantages on loans and withdrawals. Now, there are some tax considerations to keep in mind. First, the distributions must align with our ownership percentages. We can't give 50-50 owners 90% distribution and a 10% distribution. Doesn't work that way. Has to be whatever their ownership percentages are. And the IRS will mandate at least a reasonable balance be struck between our W-2 wages and our K-1 distributions to prevent tax evasion. We don't want you to be not paying payroll taxes if you should be paying payroll taxes. Now, life insurance is actually using life insurance this way is going to be positioned as a supplemental strategy to traditional retirement plans, especially for owners behind retirement savings. The strategy will focus on leveraging life insurance as a tool for retirement and estate planning while taking advantage of the tax structures of the S corporation. It'll highlight the needs for careful tax and financial planning to maximize the benefits and maintain compliance. So, all of this to say, definitely check out our complete solution from on S corporations from Ameritas. That's going to be the best way to have a conversation with those that have pass-through entities. Now, moving back to Schedule 1. So again, we're back to that additional income. If we go down to line 16, you're going to find an entry on self-employed SEP, simple, and qualified plans. And on line 20, you'll find another one for IRA deductions. Now, these line items often tell us whether clients are actually saving for retirement. If they're W-2 employees, their retirement contribution can also be seen on their W-2 statement if you have that available. But one thing you don't really think about is high earning clients are actually limited in the amount that they can contribute to a qualified plan and are not eligible for a tax credit for these contributions. As a result, they kind of suffer what we kind of term as reverse discrimination because they can't really save enough to replace their current income level like the lower earners can. So therefore, high earning clients often need additional tax efficient savings opportunities like, I can almost hear you guys, life insurance to accumulate the amount that they may need for retirement income. So life insurance is one of those few opportunities beyond qualified plans that can afford the client the opportunity to save for retirement in a tax efficient manner. And a permanent life insurance policy can offer immediate death benefit protection to ensure that the spouse has funds for their retirement while also providing a funding source for supplemental retirement income potential. So pretty good deal. After we get all of that income set aside, so if we move back to the 1040, after entering everything plus some other things that we've talked about this far, we'd arrive at our adjusted gross income. Now, before we can get to the taxable income, the taxpayer must elect either to take a standard or itemized deductions. And you tax preparers probably already know all about standard and itemized deductions. But for those that don't, the standard deduction is just a flat amount in which you can take to reduce your taxable income dollar for dollar. Whereas the itemized deduction, if you can do either or, standardized or itemized. An itemized deduction is just a bunch of miscellaneous expenses that you can total up, and that amount will be the amount that you deduct against your income. Now, the taxpayer is usually going to pick whichever is the better deal for them, so the higher amount wins. Now, standard deduction at this point in 2025, single filers and married filing separately are entitled to a $15,000 deduction. Head of household, 22,500, and married filing jointly 30,000. Again, these are all 2025 numbers. But if you see one of those three numbers, 15,000, 22,500, or 30, then we're dealing with a standard deduction. Now, if you see a different amount though, then our taxpayer has itemized their deductions. And generally, generally, these itemized deductions are going to vary by taxpayer. Every person has different expenses throughout the year, as well as a different adjusted gross income that will determine their floors. Now, what do I mean by an adjusted gross income floor, an AGI floor? Well, an AGI floor is a percentage that's put in place, a percentage of your AGI that your expenses must exceed in order to be deductible as an itemized deduction. Any expense that falls under that floor is not even considered deductible for tax purposes. So for example, let's say I have an AGI of 100,000 a year and the threshold or the floor is 7%. Well, I have to spend $7,000 on whatever that expense is before any dollar after that will count. So if I spend $8,000, 7,000 of it goes by the wayside, 1,000 of it is what I can deduct as my itemized deduction. So floors can be kind of a hindrance, but it's good to know that they're there. Now, since the standard deduction has been effectively doubled under the Tax Cuts and Jobs Act, you're likely going to see it taken over the itemized deduction time and time again. But this will likely change with the sunset, assuming that it does sunset in 2025, the Tax Cuts and Jobs Act. So it's important to still be able to navigate that Schedule A. Now, Schedule A just gives us a little bit of information about various miscellaneous itemized deductions. So like unreimbursed medical expenses, income, state and local taxes, mortgage, and charitable gifts. But we'll go over each one in turn. So starting with medical and dental expenses on lines 1 through 4. In this section, an itemized deduction can be claimed for any unreimbursed medical expenses, which includes health insurance premiums, but only to the extent that they exceed 7.5% of your adjusted gross income. So there's that floor again. Many clients aren't going to qualify for medical deductions, but with or without the deduction, this line can still be a really good conversation starter. So consider asking your client, who do you have medical coverage through? But more importantly, do you understand the difference between medical insurance and long-term care insurance? Now, medical insurance covers the cost of illnesses like doctors and prescriptions. It typically does not cover the cost of long-term care or non-medical services. Long-term care, on the other hand, covers assistance with daily activities like bathing or dressing or eating, housekeeping, meal prep, or transportation, and it also covers the cost of skilled nursing care or assisted living. That is a very big difference. They might not know the difference. They may think that their medical coverage is sufficient. So that's a really great conversation to have. The next line down is lines 5 through 7, which deal with taxes paid, state and local taxes. Now, due to recent tax reform, or not recent tax reform, I guess Tax Cuts and Jobs Act is pretty old now, but state and local taxes are deductible up to $10,000. And for many high-income earners that live in a high-income or property tax state, the cap on deductions may mean an increase in their tax liability. So more taxes, no fun. Those who have a lot of taxes, therefore, may be interested in a discussion about owning an asset that offers tax-free growth potential that might be of interest. So tax-free growth potential, life insurance, always the source. If we go down a little bit further, lines 8 through 10 talk about interest paid on a home mortgage. So life insurance is typically purchased for income replacement and debt coverage. Specifically with home mortgages, that's like the key to it. We need income to pay for the home mortgage. So if there's interest in any of these lines, that means they're paying on a home mortgage. Well, we need to make sure that their income is covered to make sure that to meet those payments. And we need debt coverage too, potentially, if they want to make sure that their home passes debt-free to the next generation. Now, mortgage is also generally a client's largest obligation. So it's a great conversation to have. Ask them, hey, have you accounted for this in your needs analysis for life insurance? Have you really considered like, hey, I have this outstanding mortgage, I need to cover that if something were to happen to me? If not, maybe we need to look at that policy and kind of increase our coverage. Finally, last but not least, in lines 11 through 14, we deal with charitable gifts. Now, clients who are making charitable gifts may be interested in other planning options that can help them really maximize their charitable legacy. We call this expanding your charitable capacity. So think of it this way. I love dogs. They're like everything. I love them so much. And I would donate everything I had to my dogs. But let's say I had a kid. Well, I don't want to leave my kid with nothing, but I still want to donate everything to my dogs, right? So what if I instead donated my entire estate to the dogs, got a life insurance policy and named my kid as the beneficiary. And now I've just replaced everything I just donated to the dogs and gave everything to my kids. So I was able to give more to them and the same amount to my kids instead of having to sacrifice what I would have given to the charity if I wanted to include my kids as part of that inheritance. Alternatively, they can purchase a life insurance policy and irrevocably name the charity as a beneficiary. That way, they just have a policy out there and they're guaranteed to give that money away to that charity. Now, if the client has earmarked other assets to provide a benefit to a charity, for example, I know some people pay tithing. It's like 10% of whatever their salary is, or they might create a charitable remainder trust or have an IRA or 401k beneficiary named at that. Life insurance can still be used to help replace or equalize the wealth to the family. Again, replacement and equalization. So ask your client, which charities are you currently giving to? It's important to know the difference between the public and private charities. Have you planned or committed to larger gifts as part of your estate plan? And what assets will you use to make these gifts? Now, these are all questions that are really important, and I hope that they were helpful to you today. Does anybody have any questions?
Hey, thanks for that. There's a few questions in the chat. Um,
Oh, I can't see the chat.
I'll unmute Alonzo because I'm not sure of the question. Hold on one second. Um, yeah, Alonzo, you should be able to because I think that question was a few slides ago, so I don't know
Yeah,
if she adjust that for you.
no problem. So one of them, you were mentioning, with the retirement accounts, and I was asking if it would be similar to like a pension maximization, um, in terms of using the life insurance as a strategy with the, for example, if they have an IRA or a qualified pension, things like, not pension, qualified retirement account. Would that be similar to strategy to a pension max using the life insurance?
I'm not sure on that one. Retirement isn't my largest forte. Troy, I don't know if you're still there. Can you hop in?
Yep, I got you. Alonzo, talk to me. Hey, Alonzo, how are you doing? This is Troy. Can
Doing
you guys hear
good.
me?
Hey
Yeah, we
Troy,
can
how
hear you.
you doing?
Good, good. Apologize. Um, I came on as Keali Jo was already rolling, so I just kind of sit in the background. So the question was what, Alonzo? Is the question was what again?
So she was mentioning one of the slides on using retirement, or using life insurance with the qualified retirement plan. So I'm guessing that's similar to a pension max using life insurance.
Well, Well, with Pension Max, you're trying to do so. I would say it's dissimilar in that with Pension Max, you're specifically talking to someone. I mean, I guess you're doing this. You're specifically talking to someone with a defined benefit pension plan that has a known number that they're going to get paid at some point based on working to a certain period. Like we know those numbers, and you're trying to use the life insurance to put us in a better situation in relation to those numbers. That's pension max. When you're using it with a qualified retirement plan, as Keali Jo talked about, you are probably the characteristic is a little bit different because we don't have that known number because it's a defined contribution plan.
Right.
So we don't have a number that's guaranteed by the pension. Life insurance helps with a qualified retirement plan, things like the defined contribution plans. It helps when we're trying to deal with RMDs.
Uh-huh.
It helps when we are trying to understand some of those lifestyle things, some of those legacy things. And life insurance can be the offset or the addition to help achieve those things with a qualified retirement plan. So it's the same realm, but Pension Max is a specific sort of concept. I think Keali Jo was referring to life insurance being used more broadly, especially with a defined contribution plan,
Thank you.
i.e., 401k, SEP, simple things like that.
Yeah, and then in addition to that, because I actually have a client who had this question with the K1s. The difficulty that he's having is, and I don't know if this is with all businesses or business owners, but his K1s are not like uniform. So, one distribution might be 30 grand, the next might be 100 grand, who knows? Um, and so his question, and I think Keali, you actually mentioned that they can actually use those distributions to fund life insurance. Would that be something that we could be able to set up where, when he has a distribution, we kind of just automatically set it to fund the premium, or would we kind of need to know, the amount of the distribution?
I guess it'll depend on the policy itself and what the premium payments are. I wouldn't know off the top of my head. I would think that you would probably just take the funds out and then make sure whatever the premium payments are being met with that. Troy, do you have anything to add?
Yeah, I would say that you would need to do on the front end, Alonzo. That's more of a product issue in terms of I need to design the product with a certain amount of flexibility. So what I would do with that client is, what do we think, sort of bottom line number, what do your K1s look like? Right. And average of a certain amount, or is it like I want to go sort of minimum amount, your K1s are this. Well, how much of that are you willing to commit to whatever you're doing from a life insurance perspective? And then you would build that flexibility in so that at a minimum it's this, or target is this, and then give yourself some room in the design of the product to be able to say, if I have a really great quarter, or I find myself in a situation that I want to put more in, I've designed the product to be able to add more to it if that's what I chose to do. Now, the downside of that is that when you build in that sort of flexibility from a premium standpoint and product wise, you also build in a little bit of drag, because because you've given yourself, imagine you've given yourself a bunch of room, but unless you fill that room up, then it's there's sort of wasted space, if you will, and that wasted space sort of drags on your performance, if you will. Where you would typically go, I want to stuff, I want to stuff it, I want to stuff a policy, or to use my analogy, I want to put as many sort of chairs in the room so that it looks full and stays full and gives me the opportunity to fill it to capacity. And that's what I want to do. So that's the sort of the trade-off. I can build in that flexibility, but unless I take advantage of it, it becomes a bit of a drag on performance. So you want to guide your client through that process pretty carefully. It's not something that we don't see, and it happens quite a bit, but it's just something that you need to be aware of, and you guide your client through it. Hey, let's just hey, I want to do $50,000 a year, but my K1s average about this, so I think I want to get to 50,000. Well, we can build it so that you can get up to 50,000 in it, but knowing that if I fall below that, it's going to be a little bit of a drag on what I'm, thinking I can be able to do, thinking I'm going to have at some point in the future.
All right, we have a
Thank
few
you.
minutes left. Nicole. Nicole has a question. Nicole, you want to unmute yourself and ask?
Yes. Hi, good afternoon, everyone. Thank you very much for this presentation. My question is, I currently have a couple clients that I do their accounting for. And one of the things is that if, for instance, they are at a point once the tax accountant, starts doing their taxes and seeing that, they may have to pay some taxes, can we set up a SEP IRA? Because they have not made any company contribution for retirement. So can we set up a SEP IRA where we can actually have a certain amount that goes into the SEP IRA to help reduce their taxable income.
Want
That
me
one
to
I'm
take
gonna,
that, Keali Jo?
yeah. I'm not
Yeah.
great with
So
retirement. I apologize,
yeah,
everyone.
that's all right. That's all right. So the answer to your question, the answer to your question, Nicole, is yes, you can do that. That is a way if if your client is saying, hey, I'm getting hammered on taxes, is there a way for me to reduce my taxable income? Setting up a SEP is an option. I would encourage you to talk to Charles, whoever it may be, and dig just a little bit deeper. And I would want to know a little bit more about that company, like how successful are they? Have they been consistently successful? How much are they looking to preserve or how much are they looking to reduce their tax liability? How big is the company? Like how many employees? Because there's other options. There's other options that I think beyond a SEP that can be helpful. Like I'm thinking, maybe I do a pension plan for them, like
Yeah.
or maybe I do a defined benefit pension plan, or I do something we call a 412(b)(3). It's a pension plan that can only use life insurance products, annuities, and whole life insurance. So there's a bunch of options beyond just a SEP. Now they may be at the stage where they're doing a SEP, and that's
Right.
fine. I don't know, and that's why I'd want to know how successful the business is, how big they are. I would ask a couple of more questions before I would go directly to the SEP.
Yeah.
But yes, to answer your question up front, yes, a SEP is an option.
Yeah, so it's different ranges. So I have some of the businesses that have employees that now I'm looking to see, a workplace plan to offer the employees so that, retention is something that is very important. So if we offer those things, then the retention level will actually increase. Then I have, another one that only has like, 2 employee and then 1. So it's different levels. So the reason why I asked for the SEP, because it's more of, that individual is himself and his son.
So Keely, I think
Right.
you mentioned it was a specific business fact finder.
Yes.
I think that's what we would need, Nicole would need, because it would address the questions that Troy have, certainly.
Yeah.
And I will send that your way. That way you can just send it out to everybody. Does that work?
Thank you.
Yes, thank you so much. Yep, so we're at the top of the hour. We thank you so much. This was a great presentation. Troy, there's a rumor that this was the first time you rolling this presentation out.
Well, not me, her. I
I
mean,
mean, Keely, I'm sorry.
yeah.
This your
I
first
mean,
time?
The very first, you guys
Oh
get the
wow.
honor.
Wow, you did great. We did great. We really appreciate that. Yes, thank you so much. So, I guess the business fact finder is the key,
Mm-hmm.
and we can fill it out. And of course, we have questions. We can email that into advanced markets, and then have like another follow up, like consultation, and then we can go from there, right, with the team.
Yep. And if you're ever
absolutely.
concerned or confused on who to reach out to on the team, just send it to that advanced funding inbox and we'll make sure it goes to who it needs to go to.
Awesome. All right. Thank you so much, everyone. And I
Thank
did,
you.
yes, Greg, I recorded. I will send that out. I appreciate it. Have a good day. Thank
Thanks,
you
Okay.
so
everyone.
Bye,
much.
Thank
everyone.
you.
All right.
Bye.
Bye bye.